In this video and the next several videos, we are going to examine a case study that we recently conducted for a couple interested in whole life insurance policies for the cash value. And the purpose of the next several videos is to serve almost as a mini series that can help provide a guide, or think of it as a tutorial regarding what questions to ask. What companies and products do most people look at? Once I've got the cash value maximized, once I've considered different products, looking at different flexibility features, all of these things that come with whole life insurance policies, once I have that information and I have that perfect product selected, then what does it look like when I use the money? So we've got a young couple here. They are in their late 30s and they're interested in whole life insurance policies, mainly for the cash value. They have a large family. They did ask about policies for the children. However, over the phone call, they stated, we might look at that in the future. However, right now we are interested in policies for ourselves, and the death benefit is all well and good, but we're interested in the cash value, Steve. So cash value is the objective, and we've got number one, how to maximize. How do I maximize the cash value and ensure I have as much money as possible from start to finish? You'll see that they are real estate investors, so they value that upfront cash value. They do not want to take a huge hit on their money and have a lost opportunity cost. No one does, so they really want to know how to maximize the upfront cash value and the long-term cash value. Flexibility is very important. They have a lump sum. We're going to look at the specific scenario in a minute, but they've got a lump sum of money they'd like to add to a policy and then commit to a minimal amount. Have you ever felt like that? Can I add a lump sum and then add nothing? Or can I add a lump sum, commit to a small amount, but then add additional lump sums as the years pass? You can do that with a whole life insurance policy. If it's designed properly and you have a company that allows that in terms of their flexibility features and such, but this is what they want, so we want to show options that accommodate that. Is the policy flexible so they can add more money at leisure, and they're committed to a minimum amount so the policy never feels like a burden? Some other questions they had. How long should we fund the policy? We might want to fund it for 5 years, although we might want to fund it for 30 years. And honestly, we don't know. But we would like to know, what's the difference between funding a policy for 30 years versus 5 years? With the exception of just adding more money into the product, are there other differences? For example, do I get a higher growth rate, a higher internal rate of return if I fund it for a shorter period of time? The answer is yes, you do. And that question came up and we talked through that as well. So how long should I fund it? We'll look at different funding periods as well. Using for real estate, this is the main goal right here. Maximize the cash value, and the more money they have access to, the more they can use it for real estate, as that is the number one goal. So the cash value, we did mention that this is their number one objective here. Core benefits of the cash value are what? Safe, liquid, and tax-free. Safe, regardless of what's occurring in the stock market, in the economy, the cash value in a whole life insurance policy will just continue to appreciate over time. And what we've seen is if the policy is with one of the major mutuals and properly designed for maximum cash value, that is, the net IRR may fall somewhere between 3 to 5% over the life of the policy. Why I say over the life of the policy is because no matter how well it's designed, I do have that negative hit up front due to the insurance expenses. We want to minimize it, but we also want to be transparent about that. Liquid, this ties right in with using for real estate. I want access to the money at all times. Also, I receive the constant compounding. What I mean when I say that is regardless if I just let my money sit and grow, it's earning a 4% IRR, or if I decide to borrow against it, take policy loans, I continue to receive compounding on my entire cash value. Any money still in equity and what I have loaned. And then tax-free. Everyone likes tax-free. Tax-free if we do everything right. Specifically, we don't trigger a modified endowment contract or another taxable event, such as letting a policy lapse with a large loan balance or cashing it out when I have a gain. There are other things that can trigger taxable events, which we have other videos on. So, a little bit more about the couple. Husband and wife, again, late 30s. Really nice couple. I enjoyed I enjoyed speaking with them a lot. The husband is in real estate. The wife's an engineer. So very technical. Him, more of a bottom line, does it make sense or does it not make sense? Her wants the details, wants to understand the product. What was neat about this call, during the call, I did mention to them, I said, when we look at the people we work with, our company, and who sets up whole life insurance policies with us, there's a variety of individuals as far as different types of people, but one type of individual always sticks out. Those who are technical engineers and then real estate investors. And a lot of times it's a combination of both. Usually an engineer or IT professional who does some real estate on the side, or perhaps they have a full-blown real estate practice. We'll usually see those two combined. And what was funny is they said, oh, well, I'm actually an engineer and he's involved in real estate. So I'm like, okay, that makes a lot of sense. But in this example, why I bring that up is when working with an engineer, getting into the weeds sometimes is important, especially if someone wants the details. Now, if someone says, hey, I don't need all the details, just show me the bottom line, we want to be able to show that too, but go deep when necessary. And then if we don't need to, then we won't. Always keep it convenient for the individual while being upfront about everything. Fun stuff, right? So here's the plan. They've got $250,000 presently liquid just in cash. What they want to do is move that into whole life insurance policies. Ideally, they'd like to split it between the two of them. That's in policy year one. So the first year, $250,000 into a policy. But if they split that evenly between both of them, what does that come out to? $125,000. And then starting year two, they'd like a minimum commitment of $10,000 per year with the ability to add more. So what we can easily do here is set up a policy where you can commit to $10K and add up to $100K per year. We can even design it, or we can go up to $125,000 per year, because when we design the policy, if we're starting off with a lump sum of $125,000, that means we do have to have a MEC limit of $125,000. And we can set that MEC limit wherever we want. What you'll find is that it has a direct relationship to an individual's age and total death benefit on a policy. So first year, $125,000, but what about after that? So ideally, what we want to do in a case like this is set the minimum premium at or as close to $10,000 as possible. This way, I've got a minimum amount that never feels like a burden. I can easily handle that. And then at my discretion, I can throw more money into the policy. Now, company selection and limitations will have an impact on this. You can do exactly what they want to do with Guardian, because we can add a large lump sum into the policy in the first year and then easily have a minimum $10,000 premium. You'll see it actually, the base premium will be a little bit less. However, with MassMutual, the base premium is a bit higher than $10,000. So they've got to commit to a slightly higher dollar amount. But again, there's two different companies. We're going to look at different products as well, just providing the awareness up front so we can hit their goal or get as close to it as possible. So this way, as they see the different options, imagine if they're on Amazon, they can see the different options. Then on the right, some other options pop up. Hey, I might be interested in that. Let me click on that and check the description. That's really the purpose, to showing other options that are very close to what they're interested in without overwhelming them. So that's a weakness I've had, overwhelming anyone for that matter, where sometimes I like to go into way too much detail. So we're going to have three parts that follow this video. Part one, we're going to look at policy options for the husband, and we'll focus just on Guardian policies. Part two, we'll look at the wife, and we'll focus just on MassMutual options. And then part three, we'll look at a combination of the husband and wife, but using the money, specifically for real estate. So with the husband, we're going to look at one product, Guardian's L95 policy, which I often refer to as a hybrid policy. And the funding questions came up. How much can we pay in? How long can we pay in? Lump sum, the $125K in the first year. Then show me what it looks like if I pay in $10K per year, $50K per year, or $100K per year. Different options so I can see what if scenarios displaying how much cash value I'll potentially have. If I paid just the $10,000 per year, I know I can hit. Or what if I paid in 50 or 100? And we can look at 30, we can look at any numbers, And in reality, often what happens is individuals' funding tends to adjust. So we might show, or someone might say, I'm going to get 100K in every single year. And then they end up getting 50K in. The opposite has occurred as well. I think I can get 50K per year in, but we build in more space with a higher MEC limit and they end up getting 100K per year in. PUA fees. So technical item here, 5% PUA fee or 10% PUA fee, which is better? We will see. The indexed rider demonstration, something Guardian offers, looking at a policy with and without the indexed rider, and then also the guaranteed values. We'll look at that specifically with the PUA rider analysis. For the wife, we're going to look at two different products, 15 pay policy and then also a high early cash value policy. 15 pay policy, how much and how long? Well, how long? Maximum 15 years. Why would I even show that as an option? Because you'll see with the high early cash value, I can fund it for 15 or until I'm 85 years old. So for a very long period of time. Well, the reason why is if we look at the 15 pay policy, the same is true of the 10 pay policy. This is specific to MassMutual. They have lower PUA rider fees. So lower fees can result in greater cash value. So looking at that, I say, okay, I might be interested in this product because it's more geared for stronger cash value. So I want to see it as an option. How much do I want to pay in? Same thing, we'll look at the lump sum up front and then 10, 50, and 100K. Hers will be a little bit more than 10 for the minimum actually. And then a performance review, directly comparing the 15 pay and high early cash value product. This way she can see, hey, if I fund it for a maximum of 15 years, because I'm in my late 30s now, I'll be 40 in a year, so 15 years, I'll be 55 years old. Do I want to continue funding it? I might not. Show me funding it for 15 years or just for 5 years. Point is, if we keep everything consistent, apples to apples, which one gives me greater value? And then take that into consideration when making a decision. And then part 3, we'll look at using the money, which we'll actually have some fun with that, and look at the combined values, meaning we're going to combine both policy values and then look at loan scenarios. We'll look at a cash value collateral loan because we can do that if we have multiple policies. We can take them to a bank and they'll give us a line of credit against the entire balance. And you can do it with individual policies too. We just have to manage each one individually. In any event, I hope you enjoyed this video. I hope you enjoy the videos to come. Please hit the like button, subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.